Thank you for joining us and welcome once again to the Wyoming Women's Business Center's webinar series. Today we welcome back Kim Vincent for part 3 of webinar series entitled, What is a Balance Sheet and Why Do I Care? I am Sherry Annenson and I'm the Executive Assistant for the Wyoming Women's Business Center, and I will be your moderator today along with co-moderator Waldo Smith, one of the business counselors and the Director of Microlending. Our speaker is Kim Vincent. She is the co-founder and COO for Local Crowd, LLC. Kim has worked extensively in both privately held and public service organizations and has worked as a business counselor for the Wyoming Women's Business Center and the Wyoming Small Business Development Center. She has a BS and an MBA in accounting and has extensive experience in assisting small businesses in financial record keeping and reporting systems. Kim has been using QuickBooks Intuit products for over 20 years and is also a QuickBooks Pro advisor. The webinar is being recorded and it will be available on our YouTube channel. Just go to youtube.com and type in Wyoming Women's Business Center. Make sure you subscribe and check out our other webinars. You can also check out our website at www.wyomingwomen.org or look for us on Facebook. All participants are muted to minimize background noise. If you have any questions during the presentation, please type them in the chat box and we will ask them for you. Now here is our presenter, Kim, and I'll turn it over to her. Thank you.
Well, thank you, Sherry, and thank you, Waldo, for all the good work that you guys do at the Wyoming Women's Business Center. And happy Friday to all of our attendees. I know you're all busy, and I'm going to try to keep this to a really concise discussion about your balance sheet. And I have this newfound love for balance sheets in businesses in terms of it's so important for you to be able to tell your financial story. We've talked so far about the whole accounting process, and you have to have practices in place and procedures in place because there's all this data coming at you in the financial realm. And you have to have a way to capture that. We've talked about some of the tools to do that. We've talked about some of the reporting tools, and once that data's gone into the system, how do you manipulate it? What are critical metrics for your business, and how do you need to think about your business in terms of some of the more critical elements that you're tracking. And today and last time we did talk about the income statement a little bit, but today we're going to talk about the balance sheet and why I think people need to take the time to create a balance sheet. Now, if we're a really single person operation, we're doing consulting, we probably we're not accruing a lot of assets. We're not stocking inventory, and we're not taking a lot of financing debt to pay for the inventory and to create working capital. But we may evolve to that. I mean, the idea is that you're putting a lot of effort into what you do, into this entity that you've created, whatever it is. If it's a sole proprietorship, if it's a LLC, if it's a S Corp. I mean, you've found your passion. You've developed this business model around what you want to do. And I just want you to think about the tools that you can use to really tell the story about your business, how it's grown, how you financed it, because you're going to need to communicate that either to other folks in your business, or your banker, or your partner, family and friends that you may want to bring in as investors. There's so many people that can really make use of the story in the long run, and we want you to get organized in the beginning of this so that by the end you have a really definable product that you can show. So what we're going to do today is I'm going to tell you a little bit about the Women's Business Center and what they do, because you can get a sense of the other resources that are there, because there might be something that you could tap into. We'll look at the program objective. We'll identify some of the previous materials we've covered. We'll talk a little bit more about why financial management is so important. And I think that a lot of you you're wearing a lot of hats, when you're coming to the table to function for your business. And I just want you to think about how we can make this hat really comfortable for you when it comes to financial management for your business. And today we're going to do it in the realm of the balance sheet, and then we'll see if you have any questions that we can share with the audience. Hopefully I can answer. So the Wyoming Women's Business Center is a nonprofit. It was originally hosted as part of the Wyoming Coalition Against Sexual Assault, Domestic Violence and Sexual Assault, as a way to help women gain, some economic empowerment and, go out and start businesses or learn the tools that they need to really grow a business. And so we're there to help businesses, and it's not just women-owned businesses, but it really is that micro enterprise. There's business services, planning, counseling. We have networking and educational opportunities. And then, which is like this class, we do some roundtables around the state. There's one in Laramie. And we look for opportunities to really give you access to capital. And I think this is really one of the strengths of the Women's Business Center, is it not only tells you how to get the money, but it offers you this pool of money if you need to apply for a loan. We want you to be working with banks. If banks have taken you on as a customer and you have a loan, or but typically most banks don't like to loan small amounts of money, and that's where I think the Women's Business Center could really fit into to providing access to capital. And we also have an IDA program, which is really awesome, a match savings account. So go online, check out the financial resources. If you're not already a client, become a client, because I think this is a great tool for you to really use this organization as a sounding board for what you need to do, where you want to go, how do you think you can get there, and what does that roadmap look like for you. And those are all tools that are available through this organization. So let's talk about reporting tools. And this is what we've been talking about over the last 3 classes, because we started with kind of the whole enchilada. When you think about accounting in your organization, how much of it can you do? Because we could actually be doing the bookkeeping piece, we could be doing the accounting piece, we could be acting as the controller. I mean, they're all very different functions. They all require a different amount of time. They all require a different amount of knowledge with regards to what you're trying to do. The bookkeeping is all of that data. We talked a lot about the different tools for collecting the data. Your objective is to touch that piece of paper once, maybe twice, so that once it gets filed, you could always tie back to it. When you're looking at your financial reports, you'd always be able to go look up the supporting data. It's organized in a way that's very accessible. But you don't have to really be working from that paper source all the time. You want to have a process for how can I do it from my computer, which program's going to be the best. Maybe I don't have to become super accounting savvy, but I can use the tools in a way that makes sense to me, and I can pull the reports that I need to pull. We talked about key metrics, and I'm really big on key metrics in terms of how you describe your business and how you look at your business success and impact, because every business is going to be different. I mean, these are totally defined for your business. A consulting service versus a retail store versus, a manufacturer, we're all going to have a different set of key metrics, but they're going to be like kind of the performance metrics for the business. How many new people do we need to get in the store? I mean, the Women's Business Center has key metrics. How many people do we want to really work with on the counseling side? How many hours do we need to work with those people? How many classes do we need to hold? So every business can really think about what it is, what's your end game. If it's in terms of a financial goal, then what are the things that you need to do to meet those goals? And I think those are your key metrics. You want to have an accounting system that's going to help you understand those key metrics and support the development of those key metrics. So we talked about best practices to put into place. because it's all about real time and it's all about accuracy. When you can pull a report, you're confident that you're pretty current on what you're seeing in that report, and you know that the numbers are really representing what's going on in the business. So those were the first two classes. Now we're going to talk about the balance sheet and why should you care. You know, when you think about a lot of the information that's out there about business success and business failure, everybody's attributing different reasons to it, and of course QuickBooks has their version of it. I mean, I think that the one thing on this, you know, there's a lot of things in the day-to-day, you know, we have a lot to do, we're behind in the entries, we're behind in the reconciliations. There's the potential for you to outsource that type of work. If it's not something that you can do, you can, you know, work with somebody else to do that part of it, but you have to be able to go in and look at it and make sure it's really, really accurate. But I really want us to think about the reports that can come out of whatever software that we're using, because that's, I think, a really important thing, is reading that story on a regular basis to know what's going on with your business, to know what the financial health of your business is, and be able to tweak it. You know, I mean, the financial reports are feedback that you need to hear about what's going on. So, you know, technology is not always going to be the solution, but there's a lot of technology that can help us support what we need to do and make it happen for our businesses. And sometimes it means we have to let go of some of those tasks, but we have to be comfortable with who's in there and doing that part of the business for us. I mean, we have to be able to go in and monitor that. So why a balance sheet? Why am I so excited about balance sheets? Well, you know, we talked about the income and the expense side of it. We talked about the profit statement, where we have all of this data collection, we have all of this input, we have some practices, we create the financial reports, and all of this really ties into the balance sheet. Every time you make a transaction regarding your business, you write a check, you buy an asset, you pay an employee, all of those things sometimes directly impact the P&L, but sometimes they'll always show up on the balance sheet, but not always through the P&L part of it. So we're going to look at that today, because the real-time piece of this, the ability to go in and look at a balance sheet, on December 15th, I know, you know, what all of these things are on my balance sheet, because I'm going to be comparing to what my goals are, and I'm going to be comparing to what my past history shows with regards to this financial reporting tool. So it's real time. You know, we think it's really good, meaningful information. We're looking at it in the context of what our critical metrics are for the business, and it goes hand in hand. The things that we've covered so far really go hand in hand with the balance sheet. So the balance sheet is really, it offers a way to look inside your business. So this middle category here is the balance sheet, and outline what this business is really worth. And that's hard for some of us, I think, because, you know, when we're just cranking along, we're a sole proprietor, we're filling out our Scheduled C, and the focus is always on the profit and loss, because when we do our Scheduled C for the IRS, we're not reporting a balance sheet. You know, when we do our income tax return for an S Corp or a C Corp, you know, the balance sheet reporting, the assets, the liabilities are all part of that reporting. So we feel, you know, we have to have that report in place, whereas for a little, you know, we're a sole proprietor, a single person operation, we don't always have this mindset of what kind of value am I creating for my business. And it really helps you. A really good balance sheet includes, you know, what do you own? Is there office equipment? It's possible that I could see some receivables, the revenue that you expect to take in, and I can see kind of the, you know, the expenses that I expect to pay out if I've, you know, been accruing my accounts payable. So getting into the details can be really, really daunting when you're starting a business, but I think it's something that's really important for you to jump into and really understand. I heard a statistic last week about all of these, the transition from boomer ownership of a lot of these small businesses all across the country. There's a really high percentage of businesses that are owned by baby boomers that are thinking about retiring, and so, what are they selling? I mean, some of them are using the strategy, can I reach out to employees? Is there somebody in my community, somebody that I know that will want to buy this business? Well, the balance sheet is really your way of showing what this value is, what the net worth of the business is, and I think that's where it becomes a struggle for folks, is you don't always report things and include things on your balance sheet that really add value to what you're doing. Now, what it doesn't show the blue sky for a business. It doesn't show that goodwill piece. Unless you've bought a business and that was factored into your purchase price, you're working really hard, you have all these assets, you may have some cash accounts, you may have some liabilities, and the bottom line is, what's that difference? The assets minus the liabilities, what is my net worth? And a lot of times you see negatives, and you see a negative equity, which is really, it just kind of hurts your heart when you see that, because you're thinking, oh, I worked so hard to create this thing, but I don't see any retained earnings in it, because that's really what people are going to be buying. They're going to be buying those hard assets on the business, and so just think about having a way to represent where you've come and where you're at right now in terms of listing your assets and listing your liabilities. And we're going to get into a little bit of more detail about what each of those look like. So there is the SBA has a really nice sample balance sheet online, and it shows some really basic things that if you want to start out, it shows what you would start out with. And everybody's statement of assets and your statement of liabilities, these are always going to be balancing, hence the term balance sheet. But they're all going to be, yours are going to be different than mine. And so just based on the nature of your business and what type of equipment you need, what type of inventory you need, what type of financing you use, there's going to be a different look to the balance sheet. But at a very basic level, it's going to be about recording your assets, and we're going to talk about these terms a little bit more, your assets, your liabilities, and your net worth or your owner's equity. And what we want to be able to do is, it's like you take a camera and you just take a picture of your business today. And that's what this balance sheet communicates. It's the company's financial condition just at one point in time. It'll change tomorrow. You put some deposits in and it'll shift within the assets. And it highlights, what do I own and what do I owe? Those are two really big questions, because sometimes when I'm working with a banker, they're going to want to see this. I mean, they're going to want to see your personal financial statement, but they're also going to want to see the business financial statement. And so that's what we want to do. So let's talk about the categories that we need. When we think about assets, so assets is everything of value that the company owns. And when I was talking earlier about goodwill, that's one of those things. It's not a tangible, and we don't necessarily put it on our balance sheet, but when we have a lot of customers, we have a really loyal customer following, and we know that on average each one of those customers is going to spend $100 or $200 a month, and we can anticipate a revenue stream based on that customer loyalty. That's a huge asset, but that's not showing up here. It's going to eventually show up in terms of the net income that's flowing into my net worth down below. But right now, I'm not going to create an asset called goodwill unless I were actually, there's a transaction where I buy a business and we allocate part of that purchase price to goodwill. So assets are just going to, when I say everything of value, there'll be some, exceptions that you can't monetize and put into your balance sheet, but you can think about it in the back of your mind if you ever wanted to sell your business. So the current assets, and these are these are assets that we can convert into cash within a year. So it's our cash. We think all the receivables that we may have outstanding. We've done work, we've issued invoices, we've created this receivable of potential cash coming in. We have inventory that we've purchased, that's going on our balance sheet as current assets. And these are all things that resemble cash, if not they are cash. Our bank accounts, our savings accounts, our CDs, our inventory, our receivables, all of those things that are really part of our working capital cycle. And current assets do go into the calculation for what our working capital is. When you think about fixed assets, well, those are things like, the facility, fixtures, equipment. It could be land, it could be buildings, it's going to be those things that you're typically depreciating over a longer time period. The other assets that we could have, there's going to be some intangibles. We may have invested in some patents. We may have, when we purchased the business, created some goodwill. And so those are the total assets. We have current, we have fixed, and we have other. The fixed assets we depreciate. So as time goes on, that net asset, those net fixed assets are going to be depreciated over time, and that value is going to be going down. And the same with other assets. We usually amortize those. So the net value of those, we're expensing them as we kind of use up their value, and that shows up as amortization, and it'll reduce the total value of our assets. And we show that as a separate line item. And I'll go in and show you another example of a balance sheet with a little more detail. So those are the assets. And now when we think about liabilities, the liabilities are going to be all the debts that the company owes. And when we think about current liabilities, okay, again, we're going to assign that 1 year time period. So it's going to be the debts that are due within 1 year from the date of the balance sheet. It's going to be all of our payables. We probably have, if we're doing payroll, it probably has some payroll liabilities in there. It's going to be the current portion of our long-term loans. The long-term liabilities are those mortgages, those real long-term debt notes that we have to pay off in the long term. So those are our total liabilities. So we have our assets, which are the positives, and we have offsetting them are the liabilities, and then the difference is kind of the book value of the company. And when we think about part of that is you probably have an equity investment in it where you've bought things in the past, or you put in some startup capital in the company. Well, that could be identified as your owner's investment. When you look at retained earnings, so on December 31st, when we close our books, we have all of the income and loss information just as a single line item flowing through the business. If I look at it right now, I'm going to have income and loss, and I'm going to have retained earnings. But those retained earnings are up through my previous fiscal year. Those retained earnings are the accumulation of all my net profits, my net losses that are being retained in the business. And this is where a lot of us see some negative in terms of that accumulation, and especially if I've been booking a lot of losses, and I have a pretty high, capital investment. I have a high basis in what I have invested in the business, and I've been, deducting that income every year. It's going to show up as this negative retained earnings. But that's not always the case. After a few years, we start having more positive income, and on December 31st, 2016, that income closes into the retained earnings, and on January 1st, when we look at our balance sheet, that income loss goes away. So when I'm pulling reports, last time we talked about, let's look at our income statement monthly and just tie it out and make sure everything, is categorized correctly, and we know what our profitability is for the month. We look at it and compare it to the previous year to see how we're doing. If we pull the balance sheet right then, we'd also see, hopefully, that same income loss amount. Whatever's showing up on the P&L is also getting ready to flow into the retained earnings, but in the current year it still shows up as a separate line item. And this is just a way to prove your work. So there was one time, these should always balance. When you look at, I'm going to go to the next one here. When you look at a sample balance sheet, the total assets, so I have current assets of $95,000, I have fixed assets of $165,000. Those are my total assets. 200. When I say this is just a sample balance sheet. Whoops, sorry about that. Just trying to scroll down in here. I don't know if I can, but at the very bottom, so my total assets balance to my total liabilities and net worth. These numbers should always be the same. 261,000 versus 261,000 at the bottom. If my liabilities are really big, when I have all these net assets of $261,000, but let's say my liabilities are $281,000. That means that my total net worth down below has to balance out to a negative $20,000 for my total liabilities and net worth to be the same. And that's where, see where my net profit's coming in, that line is always as of that day that we're looking at the balance sheet. It's the P&L for that day, so that's why we want to really have real-time information going in. The retained earnings is the accumulation of all my earnings from the past year. So when somebody looks at your balance sheet and you, like if you want to maybe find an investor or you want to get a loan from a bank, they're going to be looking at this information and they're going to be looking at your current liabilities versus your current assets. I mean, that's what, if like let's say you wanted to apply for working capital, the calculation for what you need is current assets minus my current liabilities. That's my working capital, and then I divide it by the number of days in a year. How many days of working capital do I have? Let me see if I had this. I think I had this example spelled out somewhere in my notes. So just bear with me here. So like let's say I had I have current assets minus current liabilities, and I'm going to divide it by my total annual expenses, my total annual daily expenses. So the working capital is kind of showing how my cash flow looks to be able to support those my day-to-day operations. My inventory goes up, my inventory goes down, my bank account goes up, my bank account goes down. So we want to be able to think about going in and looking at your working capital, what you need and what you actually have. Because typically they recommend that most businesses have 30 days of working capital available to them. But really a super healthy business has 6 months. And I think that's challenging for most businesses that are like in their first few years. Unless you've put a lot of startup capital in it, you don't always have that kind of working capital sitting around. But it's a good calculation to take a look at. So what we're doing is we're just taking the current assets. In this case, it's $95,000 minus the current liabilities, and we're the difference between that, and then we're just kind of averaging that by the number of days we could survive given what our annual expenses are. Okay, so there's a sample balance sheet. Yours could look a whole lot more sophisticated. I'm going to switch screens and go into QuickBooks really quick here. You know, there's a lot of detail that can go into a balance sheet, or it could be collapsed. And we're just looking at, here's my cash accounts, here are my receivables, here are my total current assets. And this is a big construction company, so this is going to be very equipment intensive, right? And I have buildings, I have improvements, and then this is where I've been depreciating my fixed assets over the course of several years. I have this category where all that depreciation that gets expensed in the year gets accumulated on my balance sheet, and it's going to reduce the value of those fixed assets. I mean, we could be really excited about, you know, this is really $543,000 in assets, but in truth, you know, the accumulated depreciation reduces that net worth. So other assets, sometimes we put security deposits down, sometimes up here that shows prepaid insurance as an asset where you pay it at the end of the year for the whole next year and then you expense it out for each month. There's different strategies for how to do that. One of the things that people use in QuickBooks is down here what's called undeposited funds. So it's like your cash register where you've received a lot of money in the business, but you haven't made the trip to the bank yet, or it hasn't transferred out of the, you know, the credit card processing account yet. That's undeposited funds is something you need to go in, and what you're doing, you know, you're reconciling all these statements. You're reconciling your checking account each month. You're reconciling, although we talked about doing it weekly depending on the number of transactions. And you want to be able to look at this balance sheet and know that each one of these accounts are totally accurate in terms of what they represent. I'm pretty comfortable. I have $30,000 in inventory. I know I still have $832 in employee advances that I can collect. So really, I think really valuable information in terms of how are you thinking about the value of your business and what you've created over the past several years, and there's, you know, there's ways to define that. There's very detailed ways to put it into your balance sheet. And then we also want to be thinking about, we're looking at our payables, because we're all getting ready for turning information over to our accountants, and that's the class we're going to be talking about in January, is really, you know, kind of not speeding up that process, but really providing the information that your accountant needs to prep your taxes, or if you're going to be brave and do it on your own. I always encourage to have a financial professional take a look at, you know, what's going on in your balance sheet. So when you think about, okay, I have all of these assets, yeah, that's great, but all of the vehicles, all of the equipment has been financed, and I'm still making payments on all of those. So I have a liability that offsets that, you know, that $400,000 asset up above in terms of how I chose to pay for it. So a lot of times what you'll see on little corporate startups is you'll have a capital stock account, which is the very initial money that you put in as when you buy your shares. The opening balance equity, some of us will have, if we set up after we've started up, we'll be bringing in some opening balance equity, which is kind of that retained earnings piece, but it hasn't been recorded in QuickBooks that way. And then we'll start creating this, we'll start seeing this retained earnings account. So here's a business that has a lot of assets, and I can't get to the bottom to see the report. Total assets of $634,000. Total liabilities of $420,000, so I have equity of $200,000, and that's based on $113,000 in net income for this year, which was 2018, and my total equity is only $214,000, and that's with half of that are the sales from the current year. So I think it tells an important story. I'm going to switch back to to this, and we're going to play from the current slide. And there's just lots of samples of balance sheets that you could get out there, but I think the beauty of QuickBooks is that, you know, it will create it for you. You're taking, number one, your balance sheet has to balance, and I've only seen one case where I was creating a balance sheet for this company, and I was looking at the total assets and looking at the liabilities and equity, and there's some little glitch that happened in the software piece where it did not balance. So it's always good to compare, just to make sure. Compare those categories to make sure your balance sheet really balances. It's good to compare your balance sheet to previous periods. So I think it's good to look at a balance sheet and you'd say, okay, I have some credit card payable. You know, I use my credit card to pay for supplies, or I'm carrying a balance. I made a big insurance payment, or I bought some inventory on the credit card. And I think you want to be able to look at your balance sheet and say, my goal is to really pay off, you know, work out my cash flow so I can pay off that credit card debt over the next 18 months. And I'm going to pull a balance sheet from last year. I'm going to pull a balance sheet from this year, and I'm going to look at what that trend was in that really important category. One other category that we didn't talk about in specifics, but your accountant will really try to look at, will be in your liabilities, in your current liabilities, when you have payroll tax liabilities. And that's something they really look at closely. They try to, you want to be able to tie it back to all the reports that you've created in terms of, have you correctly reduced your liabilities as you made your payroll tax deposit. So, but that's an important category. At the end of the year, you want to look and say, well, something weird happened because I don't think I really owe that much in payroll taxes. So, you know, I think looking at your balance sheet quarterly is a good way to start. It can kind of help with, you know, reduce any seasonality going on. And, you know, you're just looking at it thinking, wow, I've worked really hard for the past 10 years and I see negative net worth. But, you know, keep in mind, if I have been taking capital draws out of the business, that's going to reduce your capital account, and that could create some negative piece. So if I've been adding to my cash flow personally by doing owner's draws, that will have some impact on my balance sheet. But I show that as a separate category. You know, if I were to write a check to the owner and then I would show that as an owner's draw, it's going to show up in my balance sheet that way. So here I am giving you another thing to do, and what I want you to think about is having a system in your organization where you're confident you have real-time financial management, where you're making, you know, daily decisions, weekly decisions based on actual balances and, you know, correct receivables, because you are the best person to really be monitoring the financial health, even if you're not the one going in and entering the data, but you want to be able to understand the reports. If you have to pull the reports yourself, you have to really be able to use those tools to make it a timely assessment. It's okay if you want to outsource that part of it, but you have to have the ability to understand what's going on in your business. And the way you're doing that is you're looking at your income statements monthly, you're looking at your balance sheets quarterly, and there are a whole lot of activities that go into supporting your ability to do that, right? We have all of that bookkeeping that's got to go in an accurate, timely way. We have to have all of your external statements and payables really need to match what that third party says they are. If you have credit card statements, you want all of that to be really accurate. So you're capturing all the data, or somebody's helping you capture that data, and then you're going in and really using your income statement and your balance sheet as two really important management tools. I encourage folks to, it's okay to do all your accounting yourself, if you have a really good tool. But at some point, I think you want to, have a conversation with a tax professional and get some guidance on, you might be in an industry where there are some specific things going on with tax credits, or with, like, we're going to start a business, now I'm thinking about selling a business, what's the implication of is there capital gains, or did I structure it correctly to make that sale really easy to happen? So you don't have to have them do your work, but I think you want to have them periodically check your work and just make sure that things look good. Because what's going to happen, like when I work through the process of getting ready for the end of tax year, I always start with my previous year's balance sheet. And I go to, right now I'm getting ready to wrap things up for 12/31/16. I go back to 12/31/15, I pull a balance sheet, and then I go to that tax return and I want to make sure I haven't done anything in this current year to impact what I had reported through 12/31/2015, through that previous year. And my balance sheet that I communicated to my tax person, I've got to be able to match that. Every once in a while there's some things going on that change, when stuff gets dated incorrectly, but that's going to be my anchor. It's always being able to look back, see what it said in 2015, and now I'm going to look at and create the same balance sheet right now and make sure it looks the same. The amounts are the same, the categories are the same, because now I'm getting ready to close out 2016 and I don't want to have done something that impacted 2015. So it's a really great starting point for you in terms of getting ready for tax time. So that's all I have in terms of prepared materials. I think when you think about analyzing balance sheets, it's nice to have a look back of three years, because especially if you want to look at trends, how have my receivables changed? Is my receivables cycle lengthening? Do I need to collect receivables more aggressively? Has my business been slowing down so my payables are really exceeding what my available cash is? So there's so many ways to look at it, but it's going to be specific to your business and specific to what those critical metrics are that we identified in our first couple of discussions. So if there's any questions, we'd be happy to take those now. If you want to put them in the chat box, feel free. This has been recorded, so it is going to be available online if you want to go back and review some of the information. And I don't want you to feel like I'm giving you something else to do, but I'm trying to give you another way to look at your business, think about your business, and be able to share the story of your business. And a lot of it has to do with that financial piece. So,
Kim, this is Waldo. I want to kind of reiterate a comment you made earlier, how the balance sheet and the income statement have to work together to give you an accurate picture. I was financing a used car dealership one time, and he came in with his tax return, and the tax return showed that he made money. He had more income than he had expenses, and so he had to pay some taxes. But when I compared his balance sheet from the end of the year to his balance sheet from the beginning of the year, he had actually lost net worth. And the reason for that was he'd reduced his inventory significantly, but his debt had not been reduced at the same levels. And so his net worth went down because the assets were decreased. So it's really important to look at both of those together.
And I think, that comment really speaks to the type of interaction that clients can have with when you go to and work with the Women's Business Center. Share, you know, if you have a business plan or you have questions about financial statements, it's just, it could be such a great member of your team in terms of helping you answer those questions and getting you the resources that you need. So Waldo has, you know, a tremendous background in banking and a real practical approach to helping folks work through the lending process. So take advantage of that resource. But if there aren't any questions, I want to have everybody go on about their day, and I think we can say goodbye.
Yeah, thank you for joining us today, everybody, and our next webinar will be on January 9th. Please take time to complete the survey as you leave the webinar, and if you have any additional questions or need further assistance, please call us at the Women's Business Center. Thank you.